Perhaps it isn't surprising when demographic change is supposed to be a long-term, slow, structural issue that the market isn't talking about ageing in the run-up to next week's BOJ meeting. We'd argue, however, that it really should be, because ageing actually goes a long way to explain Japan's key current cyclical issue. That's the weakness of household income growth and the related failure of consumption to recover after COVID. We'll get into all of that and what it means for the BOJ next week in just a minute. Before we do, I wanted to remind you that this is part of the research we do at East Asia Econ. We publish a variety of reports, with something coming out most days, on China, Japan, Korea and Taiwan. All our research can be found at eastasiaecon.com, where you can also find hundreds of interactive and updated charts covering all aspects of macro in the region. Please get in touch if you have an interest in subscribing. With that, back to the story. The key reason ageing matters for consumption in Japan is the weakness of pensioner incomes, a backdrop that makes the continued depreciation of the yen and the strength of imported inflation even more painful for the economy. We're going to try and explain this in three parts. First, looking at per capita changes in GDP and household incomes. Second, the breakdown of household incomes into wages and crucially pensions. And finally, the economic and policy consequences of all of this. So first of all, per capita incomes. With the population now having peaked more than 10 years ago, there's a crucial difference in Japan between economic performance on an aggregate basis and what's happening on a per capita basis. The big underperformance of per capita GDP was actually really limited to the period back between 1997 and 2002. Since then, Japan stopped being a standout. It's really outperformed the rest of the world, but the steepness of the decline relative to living standards that were seen elsewhere around the turn of the millennium did start to ease. That, at least, was the picture until 2019. Since then, Japan's relative performance has once again deteriorated. While it's a more accurate indicator of living standards than aggregate economic output, even GDP per capita fails to convey the whole story. It's still only a measure of the size of the overall economic cake. What slice of that actually accrues to each sector in the economy, corporates and particular households, depends on distribution. So to get a better measure of the standards of living for individuals, it's necessary to go a level deeper and look into household income specifically. In Japan, these are a yet more subdued version of the changes in GDP per capita. Overall total output per person increased by around 20% between 1995 and 2019. In the same period, real household disposable income per capita increased by a little less than 10%. Again, trends in household incomes have been worse since the pandemic. Real household incomes have been falling since 2020 and are now no higher than they were back in 2018. Now, to explain this, we need to look at the division of household incomes themselves. The gap between GDP and household income implies that other sectors are capturing the bigger share of Japan's economic pie. Corporate profits in Japan have surged, particularly since Abenomics, and it's become a common complaint that more general reflation is being held by companies not giving back by paying higher wages. There certainly something is this, but we think only something. Official data show that the so-called labour share, employee compensation as a proportion of GDP, reached over 73% of GDP in 2022, and that's the highest since 2005. It isn't obvious that labour is losing out. There's some statistical issues involved here, with some researchers arguing that GDP is undermeasured. On their revised data, the labour share of the economy has still risen since 2015, but remains below the highs of the period around 2010. However, there are more substantive factors which explain the sort of misperceptions around wages. The first is that the strength of employee compensation has been due to an increase in the number of people working, especially women. That's welcome, but increases aggregate wages and therefore doesn't necessarily raise wages per capita. The second issue, which we focused on here, is that for household incomes, the rise isn't enough when other types of household income are falling. So, in principle, in addition to wages, household income should also include social security benefits, incomes earned on investments and savings, and the money that individuals make from starting businesses. For years in Japan, incomes haven't been nearly as diverse as this sort of backdrop would suggest. Entrepreneurial incomes have been on a steady declining trend for years. And with equity, house prices and interest rates all falling, incomes from savings have stagnated too. So that leaves the only backdrop being social welfare payments, which did at least cushion the blows to the household sector from the recessions that pushed down labour incomes in 1998 and 2002 and around the global financial crisis in 2008. However, since 2013, net social welfare payments received by the household sector have been falling. With the tax burden also rising, government policy is now squeezing households in a way not seen since the first half of the 1990s. What's the consequences of all of this? Well, from a financial perspective, with Japan's public debt enormous, it's obviously very reasonable that the government would be cutting back on expenditure. With pensions the biggest component of social spending, the government couldn't hope to control overall outlays without restraining payments to the elderly. To that end, the government in 2004 introduced reforms that effectively indexed state pensions negatively with inflation. Social security transfers for public pensions in the last 10 years to 2021 rose by 10%, but in that same period prices increased by 6%, and the number of people aged over 65 rose by more than 20%. Putting budget practicalities aside and thinking about the politics of this really is quite remarkable. It means that the government has been imposing real income per capita cuts on a group that already accounts for more than a third of Japan's total electorate. Adding insult to injury has been the government's main economic policy since 2013, a pursuit of inflation that causes real interest rates to fall. That wouldn't seem like a policy choice that would be favoured by voters when so many of them are on fixed incomes. So far, these policies haven't had obvious political consequences, in the sense that the LDP has remained in power. But if there haven't yet been political consequences for the government, then there have been economic ones for Japan. The BOJ has used the 2% inflation target as justification for keeping interest rates very low. With the Fed hiking, that's caused a sharp depreciation of the yen and a rise in import prices that has pushed up domestic inflation. With nominal wages not keeping pace and headline social security payments flatlining, the result has been a fall in real household per capita incomes. There is, of course, a cost of living crisis everywhere, but even against that backdrop, the fall in household per capita income in Japan back to 2018 levels stands out. It seems an important reason why consumption in Japan is still 3% below the pre-tax high of 2019. And with consumption accounting for over 50% of GDP, this in turn is an important factor why Japan is one of only two OECD economies where aggregate GDP is still lower than it was in the third quarter of 2019. At face value, the sluggishness of consumption and GDP don't suggest Japan needs monetary tightening. Indeed, dynamics in the household sector would seem to indicate that the BOJ needs to find a way to stimulate the economy even more. Not only does the contribution of the labour market need to be big enough to offset the flatlining of social security payments, but if the BOJ is right, and the participation rate is close to peaking, then labour earnings from here can only rise via increases in per capita wages. The problem, of course, is that when US rates are rising so quickly, the very low level of interest rates in Japan mean that the yen weakens. That pushes up import prices, which in turn adds to inflation and so constrains real household incomes. Now, of course, right now it's not quite that simple. The yen is weak, but it isn't currently falling nearly as quickly as it was back in 2022. The currency, therefore, isn't pushing up inflation in the way it was. But the weakness of the yen is still outstanding, and does mean that the level of import prices is higher than it otherwise would be. So, it doesn't seem that the BOJ would want yen strength. We would have to think that the central bank would be much more comfortable with an exchange rate that at least isn't continuing to depreciate. And so while I remain sceptical that the domestic economy is at a stage that warrants much change in the in policy, the international circumstances do now suggest that the BOJ keeps up its process of slow incremental tightening. The real risk lies in another 2022 style sharp sell-off of the yen. Given the economic damage that would cause, it seems difficult to think that the BOJ could then be able to maintain its current monetary stance. As we said, this is all from East Asia Econ. Please check out our website and subscribe if you have more interest. Thanks very much.